This is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates, and welcome to Charts and Chat for June 11th of 2023. Here we have the S&P 500 index. We're going to start with the stock market this week because it's kind of important to recognize the fact that we've had a decent market this year thus far, but it has not been, as we know, a straight line, and certainly coming off of last year. Thought I'd show you some charts. There's some really good stuff from Charlie Bolello this week. Here we have from our January 4th of 22 of last year, we were down almost 30% to our trough in October, and we have rallied back from that point. Again, we're positive for the year, but I think it's going to be important to show you in the coming slides that we really haven't had broad participation. It's been a fairly narrow uptick in this market, and if you just look at it at the headline, you feel decent about things. I think the theme that we're going to talk about is basically you've got investor sentiment that has improved. Even institutional sentiment, institutional investors are committing more dollars to equities. We're going to see that. And there's this optimism that's almost a self-feeding frenzy when you talk about the equity market. When it goes up a little bit, you feel a little bit better about things. It causes these sentiment indicators to rally, and it can almost be a self-feeding frenzy here that gains can be built upon gains when the whole economic backdrop might be a lot more challenging. And I think that's what's going on now. We've got data that we're going to celebrate, say, hey, listen, the labor market's still pretty strong. It is showing some signs of softening, and we would expect that. But then there's other things that we see, manufacturing recession, so on and so forth, that are really not that great. And you got to take it all in total here. And so when you look at the market, I think it's okay to feel good about where we've come. You see the oscillations within both the downturn as well as this more recent upturn in the market, but just know that the real story lies below the surface. Here we have some sentiment numbers from the American Association of Individual Investors. You can see that it's really at a bullish point that we haven't seen since November 2021. And on the bottom in the blue here, we've got manager equity exposure. And so this is a kind of a sign of institutional investors and their appetite towards equity investing. And you see that has clearly expanded too. So like I said, it's a self-feeding mechanism here. So you get a market moving higher, you get better sentiment, you get better equity exposure, and it kind of feeds on itself until that momentum stops. And I think what would stop this type of momentum that you see on this chart is an adverse data point on the economy that gets people refocused on what's actually going on in the economy here. So here we have volatility. You can see the elevated level of volatility we had last year to this longer trend line that goes back to like 2013. Volatility is really, really low, and there's a high degree of complacency in the market right now. You see that 13.8 on the VIX is the lowest that we've seen since really right before the shutdown here, and that was pretty complacent back then. So again, you've got, I think, this disconnect between what's going on in the economy and what's going on in the stock market, and eventually, those two things tend to kind of reconcile, but they can be moving in slightly different directions for quite a while, frankly. So continuing our conversation on the equity markets, we've got this from Goldman right here. And so Goldman has reduced their probability of recession in 2023 to 25%. They're looking for a year-end S&P 500 target of 4,500, which represents about a 5% increase from here. And you can see, their numbers in the blue as well as the consensus numbers next to that on the right-hand side. And so, they're looking for about 1% growth this year. The consensus is really looking for flat growth. And I think we'd been having this conversation about 2 months ago, that number would have been negative to the tune of about 4 to 5%. And you look at the PE ratio, the price to earnings ratio, which represents the valuation in the market, you've got 18, 0.7 times earnings expected this year and 18.2 times expected for next year. And, again, within the context of, the discussion that we're having about, is the market kind of disassociated from economic reality right now? The data economically is telling us that, hey, things are apt to slow down. It's very compelling. But the market is kind of like looked past that and said, you know what, the market's doing okay. I'm more optimistic. I'm going to put more money into equity, so on and so forth. And, if you're on the precipice of a slowdown, I will, be the first to tell you that a multiple of 18.2 to 18.7 times earnings is probably a little bit too high. And then secondarily, I think you have to be kind of a natural skeptic on what the level of earnings is going to be anyway. And again, expectations have moved higher. We got through a first quarter earnings period, about a month or so ago that was better than expected. And again, more optimism out there. And notwithstanding the fact that there's very narrow leadership in the S&P 500, that most stocks for the year are really kind of struggling to slightly up, and it's really only 8 stocks that are driving this horse this year. So again, I show you this. Goldman's obviously a very respected investment bank, really a lot of smart people up in Manhattan that think about this. And but I just want to throw a little bit of caution into the wind that expectations do not really reflect the potential for a fairly pronounced slowdown. And not that I feel like we're going to get a hard slowdown. It may be more of a softer landing, if you will. But I still think that these estimates are not fully reconciling that. And that's my point here. So when you talk about narrow market leadership, I think this slide is really important. So, we've talked a lot about the fact that this has been a very narrowly led upturn in the market this year. Essentially, we've had 8 stocks kind of lead the way. And I know you've heard me talk about 5 stocks being 25% of the index. Well, if you add Netflix and Tesla and Meta into the mix, then you get to something that's closer to 30%. So think about this. You technically have about 503 stocks in the S&P 500 right now, and you back out 8, and so that leaves well over 490 stocks that represent 75% of the index, or 70% of the index rather. And so these 8 firms here are highly important, and these are the 8 that have kind of caught this wave of the artificial intelligence, AI wave has been really powerful this year. And so these 8 stocks have done fairly well. And the rest of the market has really kind of tread water to slightly up a little bit. So it's really important to note the influence of these stocks right here. So to further emphasize the point, I want to point to this chart. And so this is basically the difference in returns year to date between the overall index that you see published and announced and discussed on CNBC. You see the difference between that S&P 500 and the equal weighted index. And that's an index that, takes out the influence of those top 8 stocks and just says, hey, everyone's, treated equally in this index. And so the return differential is like over 10 percentage points. And you can see that we've never seen this. I mean, they've been keeping records on this stuff since 1990. And obviously this is a huge delta to anything that we've ever seen before. Now, oftentimes you've seen, large gaps when the equal weight is doing better than the cap weighted index. And that's during periods, when some of these high flying stocks have not done well. But the S&P 500 has become a much more technology centric index, with the inclusion of Google and all of these other ones. It's a different index than it was even 10 years ago, and certainly 20, 30 years ago. But the difference in returns between the overall index and the equal weighted index has been dramatic this year. So heading into the Fed's meeting this week, meeting of the Federal Open Market Committee here, this is a probability showing that there's a 70% probability that the Fed pauses and about a 30% probability that the Fed's going to raise another 25 basis points. And they've raised rates 10 times now in a row. And so, what you have seen lately is this feeling that by the majority of the Fed governors, the ones that are voting at least, have said, you know what, let's analyze the data. Let's take a pause. We have 1 month of inflation data, 1 month of economic data to kind of take a look at and then make their decision on what they want to do from here. And there's a lot of debate. Or is inflation coming down? I believe the answer is yes. That answer is actually very clear. Is it going to come down materially? I'm going to make the case a little bit later that, we've got rents that are already in negative growth territory and apt to go lower. Rents are very influential in the inflation calculation. And so I think that, we're going to have a lot of debate over the coming 30 to 45 days on what the future path of interest rates, at least on the short-term basis, is going to be. And I think we're very close to the peak in this rate cycle. It has a lot of implications for, whether we hit recession, when the stock market typically reacts after you hit the peak of the rate cycle, and so on and so forth. There's a lot of implications to that. I do think I agree with this probability. The Fed is apt to pause at the June meeting, but in a second we'll talk about the July meeting. So here we have the July meeting probability, and again, Fed meetings are about 6 weeks apart. So at the end of July, Fed's going to get back together and kind of reassess and look at that data during the interim and make their decision. Right now, there's about a 53% probability that we're going to get another 25 basis point increase. That's 1/4%. 30% probability that that they're going to remain on pause, and then a 17% probability that we get a larger increase. And so there's not, I'd say 52%, 53%. It's a simple majority, but it's not this overwhelming consensus. And I think, like I said, talking through that last chart, that we're going to know a lot in the next 30 to 45 days. But right for now, there's a fair amount of speculation as to when that rate tightening cycle actually does end. Here we got a chart of interest rates over time. I usually love to show you charts that have a lot of data to them with a time series that goes back quite a ways. I'm not sure that I've ever shown you a chart with a time series going back thousands of years like this one, but this is from a book I'm just beginning to read called The Price of Time by Edward Chancellor. This is basically a book on the history of interest as it relates to financial growth and financial expansion, economic expansion. But this whole notion of charging interest and earning interest is pretty fascinating. And you can see here, the reason I put this on here is to show you that over time, interest has actually been something that has been very much a part of our history, and that those rates have generally been reasonably positive, somewhere between probably call it 2.5% and 6.5% over time. And really to underscore the fact that interest rates that for much of the last decade, or even 10 to 15 years, were so low is actually very much an outlier, with the exception of the period just at the onset of the Great Depression. We have not seen rates this low, and it is a pretty interesting anomaly, and also a pretty interesting study of the evolution of interest rates over time. Here we have inflation expectations on a 5-year basis. Right now, that's about 2.1%. A longer-term average is about 1.9%. Again, very consistent with the Fed's 2% target. But again, just to be clear, this is the inflation expectation over a 5-year period as defined by the Treasury Inflation Protected Security, or TIPS, break-even rate, the kind of the difference between the inflation protected security and its U.S. Treasury counterpart, the 5-year maturity counterpart. So, essentially we've got, longer term inflation expectations that are pretty well anchored here. Here we have price changes on a year-to-date basis, just to kind of, bring us current with where we feel, where some of these components are. Obviously you got European natural gas in the blue line here, and that's and that has a totally different dynamic to it. But when you kind of, look at some of these other industrial metals, copper are negative for the year, crude oil is negative, but it's still at kind of a elevated level, and there's some other issues with that, with OPEC, curtailing or announcing a curtailment of production, so on and so forth. And then you got wheat, which has its own dynamic with the explosion at the dam that's flooded a large part of the breadbasket in Ukraine, and so on and so forth there. But these components are negative, so we've seen a real drop in the commodity basket year to date. And I still think that, once you get past this interim period and this slowdown, that you're still kind of on the eve of a broader commodity super cycle. But, I don't really want to get into that right now, but just suffice it to say that we've had an erosion in the commodity basket year to date. Well, here we have inflation versus a year ago, and the blue represents the inflation expectation. So, we just looked at that 5-year inflation forecast, really anchored around that 2% level. Well, guess what? The year ahead inflation expectation as it sits right now is right about 2.1% ish, and maybe 2.2. And you see the actual inflation number is defined by this red line. It is coming down. So clearly we've seen peak inflation. I don't think that should be any surprise to anybody. We know that inflation is coming down. That's not a shock. It's the pace of that slowdown in inflation that's most important to us. And again, we're getting ready to talk about rents in the next slide. And just know in this conversation that rents or owner's equivalent rent is about 40% of the core consumer price index, and maybe around 25–30%-ish of the overall CPI. And so if you have rents coming down, it will tend to accelerate this downtrend in actual inflation as defined by this red line. But just know as we get into the next few charts that inflation expectations, not only on a 5-year basis, but a 1-year forward basis, are pretty well anchored around that 2%. Near-term expectations for 2023 are a little bit of a different story, but we know inflation is coming down. Here we have rents by virtue of Redfin data, and you can see here the peak in rent growth was in early 22 in the spring, and then we've had a consistent deceleration. Again, that's not to say that rents were in decline, but they were accelerating at a slower rate, so they were decelerating. And what's important here is this inflection point that we just saw in this last data point. We had the largest drop in the May data that we've seen since 2020, and for the first time since then, we have actually had a negative rate of growth in rents. So that's profound. We know that rents tend to follow prices, and of course we had price spike that was led by rents moving higher in this chart. And then we know that we've had price deceleration at the purchase level, home price level, and that has been now followed by a deceleration in rents. And so, the fact that we have an outright decline in rental prices is really, really important for all the reasons I mentioned in that last slide about the impact on owner's equivalent rent and CPI. Here's something else that I think is really germane to that discussion, and that is the multifamily units under construction. So think about apartments. These are all rental units. And, again, no surprise that we've seen a fairly dramatic rise in this. Now we were underdeveloping units of all flavors for many, many years, but multifamily has really caught the bid over the last handful of years, and we've had a real acceleration in construction lately, really, especially post-pandemic. And so why is this important? Well, we're going to get more units coming online at a time where rents are in outright decline. So you bring those units online, it's going to depress prices even further, and it's going to exacerbate the rent trend. When you have more supply coming online, your demand may not change. Maybe it will, but mathematically, it's going to put pressure on those rental rates, which will put, in turn, further pressure likely onto inflation. Here we have more inflation data as it relates to consumption. Again, this is all good data. I mean, the last few slides, like I said, there are some things that we need to celebrate, right? Rents coming down, affordability is improving, even though rates are high, and at a purchase level, it's much harder to get a house, and mortgage rates are a lot more, but so on and so forth. There are challenges, but there are also things to celebrate. And this one, consumption has remained fairly strong. That's 2/3 to 70% of our economy. So it's how the consumers are doing it that we're, I think, a little bit concerned about. You see here, durable goods kind of flatlined for a while. Now at an uptick. Non-durable goods here we see is kind of flatlined at a level above what we were used to in February 2020 before the shutdown. But what we've really seen the spike in is in services, and not too surprisingly, we have seen a lot more services inflation that has taken the place of goods inflation. And that's the service related inflation, including wages, is really what's been driving overall inflation here over the last 6 to 9 months. And you can see here, services has recovered. We're in positive growth. But again, it's the source of that spending that is something that we need to pay attention to, because a lot of people are putting this on credit cards. And as we'll see in a few slides, we're beginning to see that uptick in delinquencies and things like that. So just want to be careful. Again, you look at this data on the face and it makes you feel good, but just understand the story that's within the story. Well, here's a couple other things to celebrate. Here we've got the Baltic index. This is a freight index. We're down 88%, almost 90% from the peak. Well, that's great. I mean, obviously shippers not having to pay as much. Cost of transportation that might be embedded in finished goods, as goods that are produced overseas, transported for final sale here in the US. Well, that embedded transportation cost is not nearly what it was. That's a good thing. You look at fertilizers as it relates to the cost of agriculture, that's gone way down. That's really important. That's good, right? Obviously. And we've seen other, again, as we've just talked about, the commodity basket is down year over year. We've seen corn. Obviously, we just saw wheat. A lot of these other commodities have been depressed. Well, that's a good thing. Well, the flip side of that too is that, a lot of this is driven by some weakness in global trade and global demand. And so, again, there's always a story within a story. So let's just be cognizant. While we celebrate these numbers being lower, let's just be cognizant of, what's helping to drive this dramatic turnaround. Here we have some labor data, non-farm payrolls. We talked about this in last week's charts, and this is important to to highlight here that we had a better than expected number. We added 339,000 jobs in May. You can see the trend is above the pre-pandemic average, and it's above what we've seen in all months except for January of this year. So labor market, again, in the aggregate, showing us some pockets of strength here. Here we have more labor data. Again, charts from Charlie Bolello, and I just love his work. So on the left-hand side here, we've got something I think is pretty profound. This is a data series that goes back to 1939. And right now we sit at 29 consecutive months of positive payroll growth. And you can see over time that there's been notable periods of job growth. And we're in one of those right now. Again, that feels weird to us, right? When we think about, the prospects of an economic slowdown. Well, how on earth could we be adding to payrolls at a time like this? It is very odd, and it's one of the things last year that really gave us a lot of confidence that to say that we were not in a recession, nor were we necessarily like right on the doorstep of one. But there is some evidence that the labor market is beginning to soften up a little bit. And on the right-hand side here, another interesting chart. We've got aggregate payrolls. These are aggregate, jobs that are filled, that are in the market right now. We've got 156 million jobs or folks on the payroll right now. The pre-COVID trend, though, is at 160. You see that straight line up above. If we didn't have the pandemic, more than likely that trend would have suggested that we'd have 4 million more on the payrolls right now. And so we are still struggling to get back to that pre-pandemic level. Here we have productivity, which very clearly is in decline. You see here it's overlaid with, recession periods. This is maybe a little bit less predictive power in terms of, when you get negative productivity, does it mean that you're in recession or heading to a recession? Well, the answer is no. On the one hand, higher productivity tends to offset inflation, but lower productivity at a time where you're adding jobs, but you're witnessing a negative growth rate in gross domestic income, which we clearly are this year, is the only way that you can reconcile those two is with negative productivity. Higher jobs, lower income. The only way you get there is from like loss of productivity. And so, over time, a low, or in this case, negative productivity number is apt to slow the rate of job growth. It provides a disincentive for employers to want to add staff if they're not getting the bang for the buck, so to speak. And so this is something we want to watch. Obviously, the productivity numbers are off their troughs, but they're still negative. And again, the longer this lingers, the more of that disincentive for hiring is going to be embedded in the labor market. And here's some more labor data. We've got two more charts on labor. On the left-hand side, oddly enough, again, this ought to make you feel good, right? I mean, you have essentially 4 million more job openings than you have unemployed. So that's a pretty powerful number. So, I mean, all of the unemployed people out there technically, could have a job if they wanted it. And so in a data series that goes back to 2000, I mean, we're off our peak, but this is a pretty strong number. And then on the right-hand side, you have the quits rate. You see that is definitely off its peak. So the way to read the quits rate is this. Obviously we've had a lot of people coming back into the service sector, the reopening. And so, labor was really in control. I mean, had a lot of people. It was hard for businesses to attract and retain talent, just by its nature. The quits rate represents the rate at which people are just leaving their jobs because they feel like they have tremendous job mobility and that they could easily leave their job and get another one. So we saw a lot of that. We saw a peak in that. Now that's rolled over. Well, so what that tells us is that job mobility isn't what it was. And I think this is one of those early indicators of where of the slowdown in the labor market, and so I think we want to watch this over the next several months because I think it will manifest into some of that slowness in the labor market that we've long been anticipating. And last chart here on labor is something I thought was really interesting from Jeff Sparshot's note in the Wall Street Journal that we have this. It looks like an increasing penchant for workers that want to be part-time rather than full-time. You can see that this, this data series goes back to 2019. So you've got the pandemic dislocation, and we're kind of back to where we were before the pandemic as far as that blue line is concerned. But I think, if I had to surmise, I think this might be a trend that will continue to evolve. Obviously, people that want to be flexible, this is the new theme, right? Flexible in your workplace, flexible in your work times, and also probably flexible to some degree in work location, but also people that want to be necessarily part-time, maybe part-time in two jobs as opposed to full-time in one job for the flexibility that it kind of gives you. Now we're going to transition into some items which give me a little bit of cause for concern here, right? So we've got the yield curve, which it has a high degree of predictive power, right? We've been talking about this inverted yield curve for quite a while, and how inverted yield curves tend to lead to recessions. And the bond market does a really good job, much better than the equity market does, in foreshadowing economic trends or shifts in economic trends. And so you can see here in data going back to 1960, overlaid here with recessions, that the yield curve derived forecast of the recession probability is a pretty good indicator of recession. Now we've had a few notable false positives. So again, it's not an absolute, but it's a really good predictor. And right now we're sitting at about 70, 71%. And we haven't been this high since essentially the 80s. So, again, as you celebrate these things that are going well, consumption, labor, so on and so forth, you got to take stock of what this chart and some of this other data is telling us. And right now it's telling us, hey, this yield curve, which has pretty good predictive power, is giving us a pretty strong recession signal right now. Here we have unemployment claims year to date in the black here. You can see a notable spike relative to more recent years. You can see here in that light cream colored line, that represents 2017. And if there was a parallel to what's going on this year, it might be that year. But clearly, I mean, we're seeing a breakout in claims for unemployment benefits. And again, just like the quits rate going down, this is another one of those things. Now this is weekly data. We get this very frequently, and it can be relatively noisy. And so I don't want to get caught up in the near termness of this. You want to see how this plays out over like multiple weeks or even like 1-2 months. But if this breakout is sustained, I think that's another real clear signal that we're seeing a labor market slowdown. Now we're going to transition over to our the economy and liquidity and what's going on here. We know we've got negative money supply this year, and I've long said that I think negative money supply, when you take the punch bowl away, you take liquidity away, and it's going to bring prices down. And it's one of those things. It is tried and true. It's not just mathematical. I mean, it is empirically and very much an observation, something that is important to bringing down inflation, but also slowing the economy. And so I knew when we were talking about this debt ceiling issue, and we drew our balances down to a point where we were almost out of money, but I figured that we would have a resolution, and then at that point the Treasury was going to have to go out and sell a whole bunch of treasuries, again, to raise money to fund the government. And so what's happened here between the 2nd of June and the 5th of June is that the Treasury's gone out and they've raised about $360 billion, excuse me. Whoa. And they're apt to raise maybe another $400 billion to get up to $1 trillion of new funding to help fund our government and our large deficits and our large our fiscal obligations. And so they're raising a lot of money. So why is this important? Well, they're selling treasuries, to some degree to foreign investors, but in a very majority sense, they're selling them to domestic purchasers. And so those domestic purchasers are receiving these bonds and they're paying the government money. So that's taking liquidity out of our economy. And this is what I'm talking about when I say, having this debt ceiling crisis and then all of a sudden having this kind of cathartic, almost, rapid, treasury issuance program. It serves as kind of like somebody who's drinking out of a water bottle that's been, dehydrated, and you just yank that bottle away in fairly rapid fashion. That's what's going on right now with, right now about $360 billion worth of liquidity being withdrawn. And the fact that over the coming weeks, we're going to see a lot more being withdrawn. I want to talk about commercial real estate for a second here, because this is another one of those areas that gives me a little bit of cause for concern. This chart here is showing us the loan to value ratio of commercial real estate loans, and when you look at CRE as it's known, commercial mortgage-backed securities, or just unsecured real estate loans, and you think about what's going on in the office market right now. It's one of those things that, should give you some cause for concern. All right. And already at the beginning of this year, we could already see some tightening lending standards out there in the banking market, and then Silicon Valley Bank happened. And I think that, that whole episode probably served to kind of, almost like a de facto half to full percentage point increase in interest rates, the way it kind of like accelerated this constriction of credit. Now, you can see that loan to value ratios in commercial real estate have been going down for some time. And, but, lately that downtrend has accelerated. And so it's getting a lot tighter to finance projects out there, and notably in the office sector. Now, industrial is still doing pretty well, but office is really tough to get financed for right now. And here we have another chart on commercial mortgage-backed securities. This is the percentage of loans that are interest only, and you can see how that number's gone up over time and remain relatively high, about 85%. Well, the importance of this is you've got literally about $1.5 trillion of credit tied to commercial real estate, which is going to have to roll over at some point over the next couple of years, and interest rates are obviously higher, and we know that lending standards have gotten a lot tighter, and so the way that lenders that are willing to lend, how they compensate for the risk is by raising rates. And so I think there's going to be a pretty meaningful default situation or credit situation with regard to commercial real estate in the coming probably the coming 18 to 24 months for sure. And as a result of this increasing speculation and kind of concern over the commercial real estate sector, here we actually have credit spreads in the bond market credit that's tied to the commercial real estate sector is now trading at a much higher delta or difference to the risk-free rate. So you can see during the pandemic that spiked, kind of went down for a while, and now it's at a level that we haven't seen in quite a while. So the market is clearly pricing in some stress within the commercial real estate sector. And here's something else that I think is notable too, because this is out of Wall Street Journal, the Financial Soundness Indicator. So this is regulatory capital. They call it Tier 1 capital as a share of risk-weighted assets, which are essentially loans, right? And so you can see how that went up after the global financial crisis, and it kind of crested, and now it's back down to a level that we haven't seen since like 2016. Well, there is a move afoot to increase the Tier 1 capital ratio for large banks. Obviously in the wake of some of these, issues that we saw in the middle market banking sector earlier this year. And if they increase these tier one ratios, that means there's more money that banks have to retain to meet their capital ratios, and less money that they have to lend out. So again, one more reason why credit may be constrained in the months ahead. Here we have corporate bankruptcy filings, and this is data through April. And this is apples to apples because it's showing you each of these years going back to 2010 for the bankruptcy filings through the month of April. So you can see here that there's a notable spike in 2023. Again, we haven't seen anything this high year to date since 2010. So again, bankruptcies are moving higher. So something else that we need to pay attention to. Here's loan delinquencies. Again, something else that we need to be paying attention to. If you look at the global financial crisis, you could see a spike in all of these categories. But, if you break it down between auto and credit card, you see here on the right-hand side, those are clearly moving off their troughs. I mean, they're back at levels that we saw several years ago before the pandemic. But directionally, they're moving higher at a pretty rapid rate. So we want to pay attention to this. And then obviously you've got mortgages. The delinquency rates there are still well below pre-pandemic levels, which is a good thing, but they are moving higher. So we need to pay attention to that. And then obviously home equity kind of in that same ballpark too. Here we've got credit card lending. So I talked earlier, showed you the slide on consumption. Again, we should celebrate that. That's good. It's helping our economy. But how are people financing that? Well, you can see here credit card lending, and this is by non-bank lenders. So, let's be clear that this is a piece of the puzzle, but it's representative of the whole in the sense that directionally you can see that, you've got all of these different classifications and credit quality tiers of borrowers. They're increasing their use of credit cards all across the spectrum. So here's something else that we really need to pay attention to, and this is the LEI, the Conference Board Index of Leading Economic Indicators, overlaid with recessionary periods as defined by the NBER, National Bureau of Economic Research. And when we have had declines of this magnitude in the LEI, there's almost a direct overlay with recessions. And I've shown this chart several times over the last month or so, just so that we kind of, again, level set our thinking here and not, again, celebrate that which is still going well in the economy, but just be cognizant of what the data is telling us. And the LEI incorporates a lot of information. It actually incorporates stock market levels and growth and trends, but it also includes a lot of, leading, as its term would indicate, indicators like new orders for capital goods and things like that. So it's important as not only for the internal data, which comprises it, but the aggregate numbers and the directions and the magnitude of the trends in LEI are really, really important. So here we have venture capital, and clearly activity is slowing down. We know cost of capital is going higher. Access to capital is going down. And as the Wall Street Journal article from which this came indicates, that a lot of the business models that were really predicated on low cost of capital are challenged now. So, you've got kind of a confluence of a lot of different things. The IPO market, the new issue market is pretty much dormant right now with everything that's going on. And so, you just see activity in the kind of the entrepreneurship level just kind of slowing down right now. Oddly enough, we have the World Bank, which has increased their estimates for economic growth across the globe for 2023. That is reflected here. You look at the far right, you can see that these major areas, China, we're going to talk about China in a second, and I want to, not throw cold water on this, but just say that, there are things going on in China that we really do need to pay attention to. But nowhere in their, in their calculus for 2023 do they really see negative overall growth. Well, that sounds great, but what they're not telling you in this chart really is that they're decreasing their estimates for 2024. They are pushing this whole deceleration, if you will, out into the future. Now, what's important in this, the Eurozone in this chart for 23 is showing very slightly positive. We actually know, and we'll look at this in a second, that Europe is had 2 quarters of negative economic growth, which puts them in a technical recession. And so, a lot of, I'll say, some dissent and maybe some different divergence of opinion as far as when a slowdown is going to hit. And you're seeing a lot more maybe near-term optimism and longer-term concern over economic growth. And so that, I think that manifested in some of the data that we saw earlier from Goldman Sachs, kind of a shifting of estimates, if you will. Here we have global CPI annual change. You can see how it's evolved over time. So back a year ago, we were talking about CPI levels at maybe the 3% level, and of course, when we got to January of this year, it was a little bit higher than that, and then so we keep ratcheting that up. So the feeling is that while that global CPI is coming down, it's just coming down at a slower rate. Here, let's talk about China now. So again, not to throw a lot of cold water on this, but it is interesting, and in some respects, China is moving in a different direction than we are. So, in a similar way, you see kind of a downtick in overall trade, imports, exports, both negative right now, and that's obviously not China's model, but you did see with the reopening that exports. And I think consumption to some degree, imports demand, had actually improved, but that's rolled over now. And you can see that very notably in exports. And I think that has to do with global demand falling to some degree. On the right-hand side, we have prices in China, and those are decelerating. Now, again, we're talking about U.S. prices going down, but we're still talking about high overall inflation, and you're not having that conversation in China right now. In fact, producer prices are in outright deflation right now, and consumer prices are very close to deflation. And so when you look at this chart, what it tells you is that you've got, external consumption and demand for a trade-driven economy like China's challenged right now. And then you've got, internal price growth also very challenged. And if you're in deflation amidst that curtailment in global trade, that doesn't paint the best picture for the overall Chinese economy over the next year. Here we have some data that on port traffic. We saw container shipping prices really go down. You got air freight, merchandise trade, just sluggish again. I'd say, at least from a positive standpoint, that they're off their trough levels, but, looking at it objectively, this data is still pretty weak. Here we have the Eurozone economic growth numbers. You can see the fourth quarter and the first quarter of this year that they have experienced negative growth, which puts Europe into a technical recession of sorts.